Hi guys, I hope you're doing well. Welcome to this session where we shall be discussing IFRS 15, revenue from contract with customer. Before I proceed, my name is Luqman Rafiq and I've been in teaching profession for more than 14 years now. And I've been teaching different qualifications including the ACCA, ICAEW, CIMA, CMA USA, and at the same time, the ICAP qualification, which is the Institute of Chartered Accountants of Pakistan. So our objective of today's session is we shall try to go through the IFRS 15 revenue from contract with customer. And in addition to going through IFRS 15 revenue from contract with customer, the next thing that I would actually try to do is that I would try to make sure that we do some of the examination questions related to IFRS 15 revenue from contract with customer also. So that is also going to be one of the objective that I would actually be doing in today's session. So before I proceed, just let me just guide you people a bit that basically there are multiple topics in the SBR, and my agenda for session of today was I just wanted to make sure that I get through IFRS 15 revenue from contract with customers with you people, and that I take you people through this IFRS 15 so that you have an idea, because it's an important concept, it's an important topic and regularly examinable topic, and a lot of students, they struggle with this topic. So the recording of this session would also be made available through our YouTube channels, through our Facebook, through the different platforms that we operate with. So the recordings would be available, but again, the session is being conducted live. So I would recommend you people to attend this session live so that you could ask as many questions as you would like to as we progress through the session. Okay, so I'm going to start off with this IFRS 15, which is the revenue from contract with customer. So IFRS 15, which is revenue from contracts with customers. Now let's just try to understand something, because a lot of people, they have an issue with respect to the revenue, the understanding of the revenue. So let me just guide you people through that. What exactly do you mean by revenue? Now see, let's just try to understand something, which is basically when we talk about the concept of income, there is basically an element of the accounting which is called income. So what exactly is the income? The income is the inflow of the economic benefits. The income actually refers to inflow of economic benefits. And when we talk about the income is divided into revenue, the income is divided into other gains. So that is what the income is generally going to be. Now, let me explain to people that what exactly is this income going to be. How would you distinguish the income from the revenue? How would you distinguish the income from the other gain? So when we talk about the revenue, the concept of revenue is that revenue is the inflow from ordinary activities of the entity. I repeat, revenue is an inflow from the ordinary activities of the entity. Now, what do you mean by ordinary activities of the entity? The ordinary activity means those activities which are being conducted in a normal manner, the activities which are being a routine activities, which are daily activities, which are a routine activities, which is a daily matter, which is day-to-day matter. So something that is not unusual for you. So something that you do on a regular basis, that is going to be considered as your ordinary activity. So whatever the inflows that arise from the ordinary activities of the entity, that is going to be considered as revenue. Now, what are the examples of this? So for example, if we talk about a supermarket, so what is the main objective of the supermarket? The main objective of the supermarket is that the supermarket continuously trades. The supermarket continuously purchases goods. The supermarket continuously sells the goods. So when it purchases the goods, it sells the goods. So sale and purchase of the goods would actually mean what? This is a regular activity of the entity, whatever the goods, whether that be appliances, whether that be the bags, whether that be the clothes, whether that be the spices, or whether that be any other grocery items, whether that be meat or whether that be vegetables or whether that be fruits, etc., etc., whatever that is going to be, that is all going to be considered as an inflow. That is all going to be considered as a revenue generating activity. Why? Because this is a routine business for the supermarket. This is a regular business for the supermarket. So whatever inflows that arise from the regular business, from the routine activities, that is going to be considered as what? That is going to be considered as your revenue. So revenue is the gross inflow from the ordinary activities of the entity. Now what next is there? You talk about a bank. What are day-to-day activities of the bank? So the bank, what it does is that it actually earns fee through the multiple charges and etc., etc. The bank earns interest. The interest would be a revenue for the bank, but the interest would not be revenue for the other activities. That would be the other gains or the other income. So generally what happens is that whatever your main business, whatever your day-to-day business, whatever your routine business, whatever the inflows that are arising because of that routine business, day-to-day business, that is going to be considered as a revenue. And then there are other gains. So what exactly are those other gains? Like for example, when we talk about the gain on disposal of the assets, when we talk about the dividends income, when we talk about the interest income, like for a business other than the bank, the interest income is not going to be revenue. Like if you are a trading business, you are a manufacturing business, you are a service oriented business, this is not going to be considered as a revenue for you. So the interest income, etc., etc., all of this is going to be considered as what? This is all going to be considered as your other gains. So when we talk about the IFRS 15 revenue from contract with customer, IFRS 15 revenue from contract with customers, actually to understand this, you first need to understand what is the difference between the revenue and the other gains. So we have been able to identify that what's an income, the income is split into revenue, the income is split into other gains. Now let's move a bit forward and let's discuss further. Let's move a bit forward and let's discuss further. So basically, the IFRS 15, it says that in order to recognize revenue, there has to be a 5-step approach that you need to adopt in order to recognize the revenue. So there is a 5-step approach for the recognition of the revenue. Now, what exactly is that 5-step approach? So the number one of them is that you need to identify the contract. The number one of them is that you need to identify the contract. The second step is that you got to determine the performance obligation. The second one of them is you got to determine the performance obligation. The third one of them is you have to establish the transaction price. You have to determine the transaction price. The fourth one of them is you got to allocate the transaction price. To performance obligations. And the last one of them is you have to recognize revenue as performance obligation is satisfied. So I repeat, basically what happens is that there has to be a 5-step approach to revenue recognition. What is the 5-step approach to revenue recognition? The 5-step approach to revenue recognition is the number one of them is you got to identify the contract. That what is the contract? I'll explain each and every terminal, each and every step in detail, but let me just give you a bit of a guidance. The first one of them is you have to identify the contract. The second is you got to determine the performance obligations. The third one of them is you have to establish the transaction price. Fourth one of them is you got to allocate the transaction price to performance obligations. And the fifth one of them is you got to recognize the revenue as the performance obligation is satisfied. Now, let's just try to understand that what exactly do you mean by all of these. So I'm going to elaborate each one of them. That what do we mean by identification of the contract and what is the performance obligation and so on and so forth. So the first thing that I'm going to do is that I would say that when it says the identification of the contract, when it says that identify the contract. So what exactly do you mean by identification of the contract? So the identification of the contract would actually mean that there are certain conditions that need to exist. Like for you to be able to identify the contract, there are certain conditions that need to exist. What are those conditions that need to exist? Which is basically the terms and conditions have been agreed. Now, what do we mean by terms and conditions have been agreed? So this would actually mean that both parties understand their rights, their obligations, and they agree to payment terms. So that's an important thing. So basically one of the important thing is that when we talk about the identification of the contract, a contract exists when the terms and conditions have been agreed between both the parties, which would actually mean that both the parties understand their responsibilities, their obligations, their rights, the agreement to the payment terms. All of these things are actually understandable between both the parties. Additionally, what happens is that it is highly probable that amount will be received. Now, this is a very, very important condition. I repeat, this is a very, very important condition, which is it is highly probable that the amount would be received. So what is it? It's a highly probable that the amount would be received. This is a very important condition. Now, let me just explain to you people. Let me just elaborate this condition. At times, you can actually enter into a contract and you could even go on delivering the goods and services, but you might end up not recovering the amounts. So if there is a situation that you might end up not recovering the amount, so this is a disastrous situation. And in case if you're not going to be recovering the amount, so that means revenue cannot be recognized. Basically, you see, there is something which is called bad debt, something which is called the criteria for revenue recognition not being met. Bad debt is when the criteria is being met, the goods have been delivered, the services have been rendered, and now what is actually happening is that the other party is not paying the goods. That's called the bad debt. Now, when we talk about the criteria for the revenue recognition, so amongst the criteria, it is important that at the time of sale, at the time of delivering the goods, at the time of rendering the services, it is highly probable that the amount will be recovered. If you know at the time of making the sales, if you know at the time of delivering the goods that the amount won't be recovered, so you cannot recognize revenue. So basically, when we talk about the identification of the contract, so these are important conditions that need to be fulfilled, that need to be met for the contract to be existing, for the contract to be identified. Now, there is some exceptional treatment which I need to help, which I want you to understand is that in case if I repeat, in case if it is not highly probable that the amount will be recovered, then 5-step approach to revenue, recognition shall not be applied. Then 5-step approach to revenue recognition shall not be applied. Okay, so basically what happens is that this is a very important thing you need to understand, that in case amount is not likely to be received, the amount is not probable to be received, then what happens is that the 5-step approach to revenue recognition shall not be applied. What happens is that the 5-step approach to revenue recognition shall not be applied. You understand this point? So what do we need to do? That means the IFRS 15 won't be applicable. So what are we going to do? So in that case, in such circumstances, the revenue to be recognized to the extent of cost incurred and considered recoverable. Now, let me just guide you a bit on this. For example, case number 1, I'm explaining all the situations when the conditions do not exist for the application of IFRS 15. The 5-step approach cannot be applied because it is not probable that the amount will be recovered. What are you going to do in that case? Let's try to see. You would actually say that number 1, for example, the cost incurred is 500,000. Revenue assessed recoverable amount, and here I'm saying sale to be recognized. Now there are a few things that you need to understand. For example, case number 1, where the cost that has been incurred has been 500,000, and you assess that on the basis of this you would recognize the revenue of 700,000, and you believe that this 700,000 is recoverable, the client is going to pay, but still the revenue that you can recognize is only going to be 500,000 because there is a maximum limit. There is a maximum limit to which revenue could be recognized, which is the revenue could be recognized to the extent of cost incurred and considered recoverable. Next situation, case number 2. Let's say the cost incurred is 500,000. On the basis of this, you assess that the revenue should be 900,000, but you expect the recoverability is only 400,000. So you can only recognize revenue till 400,000. I mean, you see, you need to understand this point, that what is the sale to be recognized in the P&L? It is the amount of the cost incurred which is considered recoverable. So whatever the cost incurred and considered recoverable, that should be the amount to be recognized. Let me give you one last example. The cost incurred is, let's say, 500,000. The revenue is assessed to be 750,000, and you are expecting the recoverability to be 550,000. So again, the revenue shall be recognized to 500,000. You just cannot recognize 550,000. You can only recognize the maximum to the cost incurred and considered recoverable. That's an important thing that you need to understand. So in these three cases, what is actually happening is that in these three cases, one of the case it's 500, another case it's 400, in another case it's basically 500. So these are the three situations that are actually going to arise. Okay, is it okay now? Okay, in case one, if recoverable and assessed revenue are same, then is it not probable that no, you see what happens is that what happens is that when you were delivering the services, it was not probable that the amount would be recovered. It was not probable that the amount would be recovered. You see, I'm just trying to create a scenario for you people. I'm assuming that the amount is highly probable not to be recovered. So if the amount is highly probable not to be recovered, this is how you're going to deal with it. Other. So what have we done? We have actually discussed this situation that the revenue shall be recognized. You have to apply the 5-step approach to revenue recognition if it is basically the terms, if you are able to identify the contract. And for you to be able to identify the contract, a very important terminology is that you should be able to identify, you should be able to establish that it is highly probable that the amount will be recovered. You should be able to establish that it is highly probable that the amount will be recovered. Now let's move a bit forward. So the first step is to be able to identify the existence of the contract. The second step is basically identify performance obligation. Now, what do we mean by the performance obligation? So when we talk about the performance obligation, the concept of performance obligation is that, the concept of performance obligation is that it's a promise under a contract. When we talk about the performance obligation, the concept of performance obligation is it's a promise under a contract. So whatever the contract that you have, whatever the commitment that you have done to the counterparty, that is called the performance obligation. So it's a promise under a contract to deliver distinct goods or services. To deliver distinct goods or services. Now let me just give you a bit of an idea that what exactly do you mean by distinct goods or services. Like for example, I'm entering into a contract with you to construct house for you. I repeat, I'm entering into a contract with you to construct a house for you. Obviously, when I am going to be constructing house for you, there are going to be many components that are going to be applied into this house. What are those components going to be? Let's just try to understand. Those components are going to be what? Those components are going to be, there is going to be steel, cement, sand, wood, paint, tiles, sanitary items, electric cables, and whatsoever, etc., etc., etc. There could be a lot of things. Now, basically what happens is that, for example, there is a contract between you and me. You see, the concept of distinct goods or service, the concept of distinct goods or services is that if I provide you something, out of these, so would you be able to obtain the benefit of an item individually or not? I repeat, if you are able to take benefit of an item individually, or as the services are being delivered, or as the progress is being done, so that means this is a distinct goods or service. Like for example, let's say my agreement with you is to construct the house, but if there is a dispute that arises between you and me, and if I've delivered the tiles to your premises, if I've delivered electric cables to your premises, so what would happen is that you can still benefit from those tiles, you can still benefit from those electric cables. Why? Because you can get them installed from somebody else. You can get those tiles installed from somebody else. You can get those electric cables installed from somebody else. You don't need me. So you see, what happens is that if we are entering into a construction contract where is an all-inclusive contract, I'm going to be providing you every single item that's needed, including the labor and etc. etc. So generally speaking, what happens is that since you can benefit individually out of each of the things, therefore it is going to be considered as a distinct item, and each one of them is going to be considered as a separate performance obligation. Let's take another example to make it more clearer to you. Let's say I deliver a software to you, and within that software, there are multiple things that are included. The software license, the installation, the updates, routine maintenance. Now, what actually happens is that I have actually agreed with you, and I'm going to deliver these 4 things to you, which is the software license, the installation of the software, the updates attached to the software, and the routine maintenance and etc. Now, what is actually happening is that these two things can only be done by my company. And if you don't want the updates, it's an option. You can take the updates from somebody else. This is externally available. What happens is that these are the things which are externally available. Now, if these are the things which are externally available, so what is actually going to happen? So you see, my company has committed to you, I'm going to deliver you all these 4 things: the software license, the installation, plus what happens is that the updates, the routine maintenance, so on and so forth. I've agreed with you that I'm actually going to do all of these things. Now, what next is there? What actually happens is that, let me just guide you a bit. Basically, what happens is that the 2 things are mandatory that you got to buy them from me. But the rest of the 2 things, it's up to you. You want to buy, you don't buy. You don't want to buy, you don't buy. You buy from external party. So that means these 2 is a single performance obligation. This is another performance obligation, and this is another performance obligation. So this is in total gonna be what? This is in total gonna be 3 performance obligations. I bet this is in total gonna be 3 performance obligations. I bet this is in total gonna be 3 performance obligations. Now, is that okay? So when I talk about the performance obligation, the concept of performance obligation is promise under a contract. and promise under a contract to deliver distinct goods or services. So you got to identify if there is a one performance obligation or more than one. So whatever the number of obligations you got to identify. The clear example is with respect to this software. We have agreed to a bundle of goods where the software license would be given to you. The installation of the software would be done. The regular updates to the software would be provided to you. The routine maintenance is going to happen. But what happens is that there are two things which are mandatorily to be purchased from us. You cannot do it from outside to the third parties. But the remaining two things could be done from outside parties also. So that means you can individually benefit from the software along with installation without taking update, without taking routine maintenance. So means these are distinct items. So there are three performance obligations within this contract. One of them is license and installation. One of them is updates, and the third one of them is routine maintenance. Okay, now, so basically the second step is to identify the performance obligation. Now let's move a bit forward and let's discuss further. The third step is basically to determine transaction price. I paid the third step is to determine the transaction price. Now this is a very, very important thing because there is a lot of calculation that is involved here when it comes to determination of the transaction price. So what happens is that the transaction price simply means the consideration. So transaction price includes the consideration includes cash, the consideration includes the cash, equivalents paid. Number three is basically fair value of the assets transferred. Number four, financing components. Amounts paid on behalf of others. So there are multiple factors that need to be considered when it comes to the transaction price. Now let me just give you a bit of a guidance. The transaction price is basically the price that has been agreed between the entity and the counterparty. The entity and the counterparty, the entity and the other company with whom you are actually transacting. So whatever the price is going to be, that's going to be considered as a transaction price. Now let's just try to understand this thing, that what exactly is the concept all about. For example, the cash or the cash equivalents paid, or the fair value of the assets transferred. So you are actually purchasing, you are actually entering into a contract, or you would rather say fair value of the assets, cash or cash equivalents received, fair value of the assets received or receivable amounts paid on behalf of others. Now see, or you could rather say amounts collected on behalf of others. Now let me just explain to you. The contract between you and the counterparty is that the counterparty is going to pay you 100,000 cash. The revenue is gonna be 100,000. The agreement between you and counterparty is that the counterparty is gonna pay you 100,000 in 15 days time. Revenue is gonna be 100,000. The agreement between you and counterparty is that the counterparty is gonna transfer an asset to you. The net book value of the asset is 500,000 and the current market value of the asset is 660,000. The revenue shall be considered as 660,000. The revenue shall be considered as 660,000. So what happens is that asset, the revenue shall be considered as 660,000. Why? Because it's the fair value of the asset that is going to be received or the fair value of the asset that is receivable. So that is all gonna be it is. Then what happens is that at times what happens is that we make a sale and the sale includes the VAT. Like for example, you made a sale of 100,000 and there's a 10% VAT that needs to be included. So resultingly, it is actually gonna become 110,000. What is it gonna become? It's gonna become 110,000. So what are you gonna do? You're gonna say cash debited by 110,000, but the sales or revenue is gonna be credited by 100,000, and then you would actually have a liability of 10,000. You get it? You'll have a liability of 10,000. So let me just repeat. What actually happens is that when we say it's a cash, the cash is debited by 110,000. The sales is gonna be credited by 100,000 and the liability is 10,000 because the sales, they exclude the amount collected on behalf of other. So if the VAT is being collected on behalf of the government, I repeat, the VAT is being collected on behalf of the government. So if the VAT is being collected on behalf of the government, so what happens is that this has to be shown as a liability. It's an amount which does not belong to you as an entity. Yes, Saqib, you can get in touch with our team. It's basically, you could get in touch with them on this number. Okay, now, so revenue does not include the amount collected on behalf of others. You see, what happens is that the revenue does not include the amount that you collect on behalf of others. At times, what happens is that you people would have heard about the principal and agent relationships. I bet you people would have heard about the principal and the agent's relationship. Now, what exactly is this principal and the agent relationship? Let me just give you a bit of a guidance that what's a principal agent relationship. So a lot of you see the car dealers, the car showrooms. A lot of car dealers or the car showrooms that you have. Now, what actually happens with the car showroom? Let's try to understand. The car manufacturer, they own the car. They place those car on the showrooms. And the showroom people, they've got a certain commission, let's say 10%, 15%, or whatever the sales that actually happens. So let's just try to understand. If for example, as a car showroom, you sell something for $500,000. So out of this 500,000, only 10%, which is $50,000 belongs to you. The rest does not belong to you. So what are you gonna do? You're gonna say cash debited by 500,000. The sales are gonna be credited by 50,000. And the liability is gonna be credited by 450,000. So basically, the revenue excludes the amount collected on behalf of others. So when you have got revenue, it excludes the amount collected on behalf of others. It does not include it, it excludes it. Now, there is something that the final thing with respect to this revenue transaction price is that we've got this last situation, which is the financing component. When we talk about the significant financing component, what exactly do you mean by significant financing component? You see, generally what happens is that the time between delivery of goods / services and receipt of revenue. If the time between delivery of goods or services and the receipt of revenue is more than 12 months, then there exists a significant financing component. Okay, Mohammed, I'm just gonna zoom out a bit. You can just write down the entry. I think it's visible to you now. Okay, lovely, Mohammed. Thank you. Okay, now if significant financing component, now what do you mean by significant financing component? Whenever there is a time of more than 12 months or 12 months or more between the time at which the amount is being paid related to the goods or services and the delivery of the goods or services, in that case, there exists a significant financing component. And what do you need to do? You need to incorporate that significant financing component in your calculations. Now, how do we go about incorporating the significant financing component? Let me just guide you a bit. So for example, there could be two situations, which is amounts received in arrears. What do you mean by this? The amount received in arrears is going to be the case where, let's say, transaction amount is $300,000. Amount payable in 3 years time the discount rate is 10%. So when you've got the amount received in arrears, what do you mean by this? You sold today 300,000. The amount that the customer is going to pay you, it is going to be in 3 years time, and the discount rate prevalent is 10%. How you as an entity gonna recognize this sale transaction? You're gonna say, first of all, let's just try to calculate the present value of this $300,000, which is receivable, multiply by 1.1 power minus 3. So hence, resultingly, what's gonna happen? $225, $394. So what are you gonna do? At time period 0, you're gonna say receivable debit by 225, 394. Revenue is gonna be credited by 225, 394. What's gonna happen? You would say receivable debit by 225, 394, and the revenue is gonna be credited by 225, 394. Why? Because what has actually happened is that you have made the sales. The amount would be received in 3 years time, and the present value turns out to be 225, 394. Now what would happen is that there is going to be unwinding of discount. How would this unwinding of discount take place? The unwinding of discount would take place like this. You have it time period 0, 225, 394. Then there is going to be interest at the rate of 10%. 22540, right? Probably into 10%. 225, 3940 whatsoever. So at the end of year 1, it's gonna become 247, 394. Now, let's just try to understand. What's gonna happen is that you would say receivable debit by 22,539, and you would say interest income credit by 22,539. Receivable debit by 22,539. Interest income credit by 22,539. right? Receivable debit 22,539, interest income credit by 22,539. Then what actually happens is, again, there is going to be unwinding of discount for the year 2. Opening receivable 247,934. Interest at the rate of 10% is 24,794. Become 272,727 at the end of year 2. And then what happens is that it's again interest at the rate of 10%, gives you 27,273, makes it a total of 300,000. So basically you're going to be recognizing the interest income of 24,794 at the end of year 2. You'd be recognizing interest income of 27,273 at the end of year 3. Hence, resultingly, what happens is at the end of year 3, this is gonna be standing. Your receivable would stand at 300,000. So you are simply gonna do what? You're simply gonna do this. You're gonna say cash debit by 300,000. Receivable credit by 300,000. Cash debit by 300,000 and the receivable credit by 300,000. Now, so this was basically when the amount is received in arrears. I bet this was basically when the amount is received in arrears. Now let's just talk about a situation where the amount received in advance. I bet let's talk about a situation where you've got the amount which is received in advance. Now, what do we mean by this? For example, this is time period 0. For example, this is time period 0. Agreement to sell goods is undertaken. The goods will be delivered in 2 years time. $300,000 paid in advance. Normally, such transactions are undertaken for $330,000 on cash basis. Now there is something I want you people to understand. There is something I want you people to understand. Now what is it? Let's try to see. There's an agreement to sell the goods which is being undertaken, right? Okay. The customer paid you in advance 300,000. So he paid you 300,000 at time period 0, and you would deliver the goods after 2 years. Had this been a cash transaction, he would have paid you 330,000 after 2 years when the goods would have been delivered. So technically what happens is that, what has happened is that he has paid you earlier, and instead of charging him 330, you are charging him 300. So this 30,000 difference is actually your financing, is actually the loan that you have taken, is the advance that you have received right now. So it's the cost that you are bearing on this. So what are we gonna do? We're gonna say, okay, let's try to calculate the effective rate. The effective rate is gonna be 300,000 into 1 plus R power 2. Why? Because it's twice, one and year 1 and year 2, twice, is equivalent to 330,000. And then what are you gonna do? You're gonna say 1 plus R is equivalent to 330,000 divided by 300,000, and then this is gonna become under root. So the R is gonna become 330 divided by 300 minus 1. Can any one of you just let me know what's gonna be R? Can any one of you just let me know what's gonna be R? Okay, I'm getting two answers and they are very, very different. 10% and 4.8%. Can anyone else just calculate? Can I have one more answer, please? Yeah, can anyone please just do the calculation? .8, 4.9%. Okay, roughly 4.8 4.9% is what it is, right? Approximately. Now, thanks, Mohammed. So you're saying it's 4.88%. Now, okay, let's move a bit forward, guys. So basically, what are you gonna do? You're gonna say, um, at time period 0, it's gonna be cash debited by 300,000 and unearned income, which is also called contract liability. It's gonna be credited by 300,000, right? Then what happens is at year 1, you would say finance cost debit, contract liability credit. The liability would increase by 4.88%. Same would happen at year 1 and year 2 both. And at the end of year 2, you would say contract liability debit by 330,000 and the revenue is gonna be credited by 330,000. So the contract liability is gonna be debited by 330,000 and the revenue is gonna be credited by 330,000. So just try to understand that basically at time period 0, you're gonna recognize contract liability. At 1 and 2, there is going to be a finance cost and contract liability increase. And at the end of year 2, what's gonna happen is the contract liability would be debited and the revenue would be credited. Is that okay now? Is that okay now? Okay, lovely. Now, let's move a bit forward and let's talk a bit further. So generally what you need to do is that you need to understand that the transaction price establishment is something that requires you to understand that what's actually going on. What are the inflows? What are the timing of the inflows? What is the fair value of the goods or services received and so on and so forth. Then what actually happens is that the step number 4, which is allocate the transaction price to performance obligation. The step number 4 is to allocate the transaction price to performance obligations. Let's have a discussion on that. When we talk about allocating the transaction price to performance obligations, so as per IFRS 15, IFRS 15 says that the transaction price shall be allocated to performance obligations on the basis of standalone prices. The transaction price shall be allocated to the performance obligation on the basis of standalone prices. Now, what do we mean by this? Let's try to understand. For example, there is a contract in which performance obligation 1, performance obligation 2, and performance obligation 3. These 3 performance obligation exist. So what actually happens is that, let's try to understand. As a bundle, all three performance obligations are being sold for 500,000. But generally, the standalone price is like this: $100,000, $400,000, 200,000. So if you try to identify the standalone prices of all these, it's gonna be 700,000. That's what the standalone prices are. Allocated price is going to be what? The allocated price is going to be, you would simply say 500,000 multiplied by 100 divided by 700. 500,000 multiplied by 400 divided by 700. 500,000 multiplied by 200 divided by 700. So hence resultingly what happens is 500 into 100 divided by 700. $25,714. 142. 857. Now let's just try to understand this. Basically what happens is, standalone prices, normally if this obligation would have been committed, how much would have you charged? That's the normal price, right? Then allocated price is basically the price out of this 500,000. What is the price that we are allocating? That's called the allocated price. So you see, this 500,000 is a bundle price for these three, and we are allocating it accordingly on the basis of the relative standalone prices, so that we could get an idea, right? So you got to allocate the transaction price to the difference performance obligations on the basis of standalone prices. Now there is this one final step with respect to the IFRS 15, and that's basically recognition of revenue as the performance obligation is satisfied. Now what do you mean by this? I repeat, it's about recognition of revenue as the performance obligation is satisfied. Try to understand this. Basically, the performance obligation could be satisfied at a point in time, or performance obligation could be satisfied over a period of time. I repeat, the performance obligation could be satisfied at a point in time, or it could be satisfied over a period of time. Let's try to understand this. What do you mean by at a point in time? So generally speaking, when we talk about the goods, usually when the goods are delivered, the risk and rewards are transferred. So the performance obligation is mainly satisfied. Over a period of time is usually in the case of services, like it could be education services, it could be construction services, it could be a lot of things. but it's over a period of time. It's not like right now, it's over a period of time. So if the revenue is recognized over a period of time, what do we do? We apply a stage of completion method. What do we do? We apply a stage of completion method. Now, what exactly do you mean by stage of completion method? Try to understand this. When we talk about the application of a stage of completion method, the stage of completion method would be, okay, you see, our revenue could be recognized at a point in time or over a period of time. What do you mean by at a point in time? At a point in time means at a certain point of time, the revenue has to be recognized. Usually in the case of goods, the goods are being delivered. The moment the goods are being transferred, the revenue is recognized. Over a period of time means gradually, slowly, the revenue is being recognized. So in the case of services, usually the revenue is recognized over a period of time. And in that case, what we do is that we use the stage of completion method. Like every year, we're going to recognize the revenue on the basis of the stage of completion, that to what extent the work has been completed, to what extent the work has been completed. So in order to determine the stage of completion, there are actually two methods. What are two methods of that? One of them is basically called input method. The other one of them is called output method. One of them is called input method. The other one of them is called output method. I can give you an example of input method, like maybe cost incurred divided by cost budgeted. The output method, work certified to be complete divided by total contract revenue. The output method could be, let's say, number of floors completed divided by planned number of floors. It could be labor hours input divided by budgeted labor hours. There could be many things that could happen. So you need to apply stage of completion. Let's say if 40% of the work has been completed, so you recognize revenue for 40%. If 50% of the work has been completed, you recognize the revenue for 50%, and things go on and on and on. This is how things are actually going to be. So resultingly, that's how you recognize the revenue. So that's basically the major thing about IFRS 15 revenue recognition, which is the 5-step approach to revenue recognition. Now, what happens is that all of the exam questions, all of the situations are more or less, they arise on the basis of this. There are things which is contract modifications. There are things which is the the amount of the contract asset that needs to be presented and things like that. But again, that's something that we can actually cover up through the practice questions. Out method. Okay, output method is what you could see, what you could actually see from the output, whatever that has been generated, that's called the output method. Okay, good enough, guys. So just let me know that if all that we have discussed is clear to you people, and in case if you people have got any queries, any issues, any problems, any things that you would like to ask, I will be very happy to answer. So just let me know in case if you have got any queries, any issues, any problems. And I hope that you all enjoyed the session. Would appreciate your feedbacks on the session also. Okay, you see what happens is that I agreed to constructing a building, Sheros, and that my agreement was that I will get $1 million. Now, every 3 months, 6 months, 1 year, we appoint a surveyor. That surveyor actually inspects that to what extent the work has been completed. Maybe he says $250,000 work has been completed. So if he says that $250,000 work has been completed, $250,000 work has been completed. So resultingly, what's going to happen? What is actually going to happen is that 250,000 divided by 1 million is the stage of completion, is the stage of completion. No, no, it's not the same as input. Input is like the cost incurred. Output is we are talking about revenue. We are talking what we can see. Input is what we have inputted, like labor time, machine time, material. Yeah, revenue generated as per completion of work. Yes. Okay, you see what happens is, let's say, let's just try to understand this. For example, the revenue agreed is $500,000. Now, what has actually happened is that 40% work has been completed. Let's say, let's just take an example that 40% work has been completed. So what are you going to do? You're going to say receivable debit by 200,000 and sales credit by 200,000. That's it. That's it. That's all that you have to do. You don't have to do anything extra. Yeah, 500,000 into 40%. Morena, don't worry about it, as I will actually later on do the exam questions class on IFRS 15. I'll actually be discussing that, so you don't worry about it. Okay, now thank you, Julius, for your feedback. Thank you, Mohammed, for your feedback. Okay, Amara, like your question that for the principal and agent relationship, shouldn't the sale be cleared by 415? No, it's not going to be like this. See, you're talking about a car showroom. The car manufacturer has placed the car on the showroom. The car is going to be sold for 500,000. And out of those 500,000, only 10% belong to the showroom guy. The rest 450 is to be remitted back to the car manufacturer. So you are recognizing revenue in the books of car showroom. So the showroom guy is only going to recognize 50,000. They're not going to recognize the whole 500,000, right? Okay, good enough. So anyone, if in case if any other queries that you have, you're most welcome to ask. Okay, anyone, any other question? I'll just wait for 1 more minute before I conclude the session. So in case if any one of you would like to ask, any question, you're welcome to ask, or else we are going to conclude the session. You're welcome, Mariza. Thank you for this. Okay, guys. So thanks a lot. See you again, inshallah, later on with any upcoming sessions. Thank you.
So this is one of the accounting examination question that is available in front of you. The name of this question is Verge company. We are not going to be attempting the entire question of Verge company, but we'll only be attempting the part of this question Verge company. You are being required that advise Verge on how the above accounting issues should be dealt with in its financial statements for the year ending 31st March 2002 and 31st March 2003. So let me repeat, what does it say? It says advice on how the above accounting issues should be dealt with in its financial statement for the year ended 31st March 2002 and 31st March 2013. Now what I would want you people to do is that I would want you people to kindly review this question and then we shall start discussing. If I talk about this specific contract Verge company, so let's try to decode the question that what exactly is happening in this specific question. Let's try to decode it. Let's try to understand this. First of all, what has happened is you have entered into a contract. What have you done? You have entered into a contract with Verge company. There is this Verge company and there is this basically government agency. So we are actually accounting for this Verge company's financial statements. The contract price is actually $5 million. The contract term is actually 3 years. The contract term is actually 3 years. And what happens is the advance that's being paid is $1 million. The advance that's being paid is $1 million. The remaining amount to be received at end of contract. Now, try to understand this thing. 1st April 2000, what is actually happening is it's 1st April 2000x1 is when the contract commences, and you get an amount of $1 million here. Then there is this 31st March 2000x2. Then there is this 31st March 2000x3. At 31st March 2000x2, what actually happens is 31st March 2000x2, you are actually going to be invoicing 2.8 million. Here you have invoiced 1.2 million more, and at 31st March 2004 you will be receiving the money. There is another date which is 31st March 2004, and where the receipt is going to arise. What's going to happen? The receipt is going to arise at this specific date. Now let's try to understand how would things go about. First of all, you would understand this, that there is a significant financing component involved. Now, what do we mean by significant financing component involved? The reason being, at time period 0, they are paying us $1 million. At time period 1, they'll pay 0. At time period 2, they'll pay 0. At time period 3, they'll pay 4 million. So if at time period 3, they're going to pay us 4 million more. So that means we have performed the work here. This work is being paid here. This work is being paid here. And obviously this work is being paid here. So resultingly what has happened is, that means what we need to do is that we need to incorporate the discount rate effect in our computation. Discount rate effect in our computation. So I'm repeating, what do we need to do? We need to incorporate the effect of discount rate computations in our computations. So how exactly are you going to do it? Let's try to have an understanding. See, it's one of those contracts that's completed over time. So hence what would happen is the revenue would also be recognized. The revenue will be recognized over time. At 31st March 2000x3, 31st March 2000x2, of the 2.8 million, 1 million has been received. So the balance 1.8 million is going to be multiplied by 1.06 power. Is going to be multiplied by 1.06 power minus 2. Why? Because this is time period 1 and the cash would be received at time period 3. So not at time period 2, not at time period, it will be received at time period 3. So that means this 1.8 million would be received in 2 years time. So can you just compute the present value and let me know how much is the present value? Okay, we have got 1.6 million. How much is it? 1.6 million. Okay, so what we should be doing is at 1st April 2000x1, you should be recognizing this cash as to be debited by 1 million and then contract liability credited by 1 million. At 31st March 2002, you would say contract liability debit by 1 million, the receivable debited by 1.6 million, and sales need to credit it by 2.6 million. Is everyone okay with this? Is everyone okay with this double entry? It's all based upon whatever that we have discussed earlier with respect to IFRS 15. So what's actually going to happen is you would say at 1st April 2000 cash debit, contract liability credit. At 31st March 2002, you would say contract liability debited, receivable debited, and sales is going to be credited. What's going to happen at 31st March 2003? At 31st March 2003, there's going to be unwinding of discount. There's going to be unwinding of discount. Now, what is that unwinding of discount going to be? There's going to be the receivable, which has an opening balance of 1.6 million. And then there is going to be interest at the rate of 6%. There's receivable, which is 1.6 million. And then what is going to happen is it's going to be 1.6 into 6%. So this is actually going to be 0.096. Hence, what happens is this would become 1.696. So you would say that receivable debited by 1.696, sorry, receivable debited by 0.096 and interest income is credited by 0.096. And similarly at 31st March 2003, we have actually invoiced them for 1.2 million. So if we have invoiced them for 1.2 million and we are expected to receive this 1.2 million after 1 year. So how much is going to be the present value of this 1.2 million? Okay, it's actually going to be 1.132. Hence, what is actually going to happen is you would recognize another entry which is receivable debited by 1.132 and sales credited by 1.132. This is how you will be recognizing it. Let me repeat, this is how you will be recognizing it. So if I could just sum up whatever that we have discussed, let's just summarize how the entire accounting is going to be done. The entire accounting is going to be done this way. How? First of all, what has happened is you have received this advance at year 1. So you would say at time period 0, you would say cash debit by 1 million, contract liability credit by 1 million. The amount of revenue 2.8 less 1 million, 1.8, which is marked, which is being charged at the year 1 end, is going to be discounted. So the present value turns out to be 1.6. At year 1 end, you say contract liability debit, receivable debit, and sales credit. And at 31st March 2003, the unwinding of discount is going to happen on this 1.6 million of receivable. So receivable 1.6 million, interest at this amount becomes this. Then you would say receivable debit, interest income credit. At 31st March 2003, the 1.2 which is receivable multiply 1.06 power minus 1 gives you 1.132, and you would recognize receivable debit 1.132 and sales credit 1.13. Kindly check and kindly confirm that you all are okay with this. Okay, this is very much what we discussed in our previous class while we had a detailed discussion on IFRS 15. So it's good to see that everybody is okay with it. Okay, great. So we are done with this specific question, which was one of the parts of the question, the name if have a Verge company. This is one of the exam questions which is pertaining to the IFRS 15. The question says that Stupa Limited sells electrical products at the following standalone prices. So the product E1, product E2, and the product E3 are being sold at this price, and this price. Now it says calculate the transaction price to be allocated to each product under each of the following independent situations. So what do you need to do? You need to calculate the transaction price that is to be allocated to each product. That is to be allocated to each product under each of the following independent situations. Now, what are those independent situations? The first one of them is it says SL offered to sell 1 unit of each of the above products for rupees 90,000. So, what do we mean by each of these products? E1, E2, and E3. SL regularly sells 1 unit each of E2, E3 together for 70,000. So, that's one requirement. What's the second requirement? The second requirement is SL offered to sell 1 unit of E1 and 2 units of E3 for 104,000. So there are two different types of transaction. And what the examiner is expecting you to do is that the examiner is expecting you to actually, I repeat, the examiner is expecting you to tell him that what is going to be the transaction price that would be allocated to each one of these items if the entity sells in this specific manner. Now let's just try to have a discussion and understanding of this. So the first thing that we need to do is that we need to understand something with respect to this, that how the revenue recognition is performed. So if I talk about this Stupa Limited, the one specific principle with respect to the transaction price is the allocation of the transaction price. So always remember the transaction price is allocated on the basis of standalone prices. The transaction price is allocated on the basis of standalone selling price. I repeat, the transaction price are allocated on the basis of standalone selling prices. Now, when we talk about the transaction prices being allocated on the basis of standalone selling prices, what exactly do you mean by this? This would actually mean what? You are actually selling E1, you are selling E2, you are selling E3. The normal selling prices of these E1, E2, and E3 are what? The normal selling prices of these E1, E2, and E3 are 30, 30, and 50. So it's 30,000, 30,000, and 50,000. So resultingly, it's actually 110,000. That is the normal selling price. Now, what has actually happened is your selling price is what? You have actually sold it at the discounted price. So your discounted price that you have actually sold it is at 90,000. So resultingly, there is a discount of 20,000. I repeat, there is actually a discount of 20,000 that is applicable. Now, if there is a discount of 20,000 that is applicable, how exactly are we going to be allocating this specific discount? So what we need to do is that we need to see that is this discount a normal discount or is this an abnormal discount? I repeat, what do we need to do? We need to see that is this discount a normal discount or is this an abnormal discount? Now, how exactly would we know that this discount is a normal discount or this discount is an abnormal discount? So let's try to understand this thing. Normally what happens is you sell E2 and E3. E2 has a selling price of 30, E3 has a selling price of 50. So the standalone prices turns out to be what? The standalone prices turns out to be 80,000. What you do is that you sell them for 70,000. So that means you normally give a discount of 10,000 on this E2 and E3. I repeat, what you normally do is that you give a discount of 10,000 on this E2 and E3. So I repeat, generally speaking, what happens is you have a discount of this 10,000 on this E2 and E3. Now, what is actually going to happen? Let's try to understand this. Now, so this E2 and E3 are normally sold as a bundle. So a discount of 10,000 is usually being provided on them. I repeat, a discount of usually 10,000 is being provided on them. So now what happens now is that, what you are going to do is that you're going to say that of the total discount, I repeat, of the total discount of 20,000, a discount on E2 and E3 of 10,000 is to be allocated, and the balance discount of this 10,000, I repeat, the balance discount of this 10,000 is to be allocated on what? The balance discount of this 10,000 is to be allocated uh, on this E1, E2, and E3. And how exactly would you be allocating this discount to E1, E2, and E3? So you would say that the E2 and E3 in combination are being sold at 70,000. This one in isolation is being sold at 30,000. So resultingly, if we have to allocate the discount, what are we going to do is that we're going to say 10,000 multiplied by 30 upon 100. So this is actually going to be 3,000 on it. And it's going to be 10,000 multiplied by 70 upon 100. So it's going to be 7,000 on this E2 and E3. So generally what happens is you need to understand this thing, that the scenario was like this. I repeat, the scenario was like this. You had E1, E2, and E3. Individually, when you sold them, you could actually sell them for 110,000. But you have sold them as a bundle for 90,000. That means you have provided a discount of 20,000. So how is this discount going to be allocated? So before we go on allocating the discount, the first thing that we need to understand is that generally speaking, the E2, E3 are being sold as a bundle, and they're being sold as a bundle for 70,000. So you normally give a discount of 10,000 on this E2 and E3. So if you normally give a discount of 10,000 on E2 and E3, so that means the first thing is, out of this 20,000, the 10,000 is to be allocated to E2 and E3. The balance 10,000 is to be allocated to E1, E2, and E3. You need to treat E2 and E3 as a single bundle, which is being sold for 70, E1 sold for 30. So now 30 plus 70 is 100,000 in total. So 10,000 into 30,000, which is this price, divided by 100,000, gives you 3,000 discount on this. 10,000 into 70,000 divided by 100,000 is a 7,000 discount on this. Do you people get it now? I'll allocate the discount to each one of the single item also. Don't worry about it. I'll allocate the discount to each one of these single item also. Don't worry about it. Okay, now see. So what happens is, how is this discount going to be allocated? So your discount is going to be allocated like this. The individual products E1, E2, E3. You would say standalone price is going to be 30,000, 30,000 and 50,000. The discount, the original discount is going to be what? The original discount has to be allocated to these two. So it has to be what? 10,000 multiplied by 30 upon 80. It has to be 10,000 multiplied by 50,000 upon 80,000. So the initial discount that needs to be allocated, it needs to be allocated on E2 and E3. So it's going to be 3,750. And it has to be 6,250. So after discount, the price is going to be what? I'm really sorry, my writing is very bad now. After discount, the pricing is going to be what? 30,000, 26,250, and 43,750. Now what happens is that there is going to be another allocation of discount, which we have calculated here. and this allocation is going to be 3000 here. So the net price is going to be 27,000 here. The discount that needs to be allocated over here is what? Is going to be this 10,000 into 26,250 divided by the total of this, and this is 70,000. Is going to be further 3750. Resultingly, it's going to be 22,500. It's going to be 6250 here. So hence 37,500 here. And if you sum up this total, this is going to become what? This is going to become 90,000. So kindly look at it, kindly see how we have allocated the discount. The individual products, their standalone prices were established. The bundle discount was allocated to these two products initially because these two are being sold as a single product. These two are being sold as a single product. So the bundle discount is allocated to them. The revised prices are established, then additional discount is allocated here. The additional discount of 3,3750, 6250 is being allocated here. So resultingly, this turns out to be 90,000 now. Or we have made an error. Yeah, we have made an error. What is that error? Let me tell you. The allocation here is incorrect. I have actually allocated the whole 10,000, whereas I should have been allocating the 7,000, not the 10,000. I should have been allocating the 7,000 because the 3,000 is allocated here. So it's 2625 here, 23,625. And 4375 here. Kindly check, it's going to be 90,000 now. Yeah, it's part one. Yeah, Anaswara, but this is what IFRS 15 is. The confusion could be there, but again, you need to see. I mean, like if you don't understand this, try to focus what I did here. I'm just going to zoom out. What did I do here? I initially said that 30, 30, 50, 110,000. The discounted price is 90,000. So there is a total 20,000 discount. And this 20,000 discount is going to be allocated 10,000 to E2 and E3 first. Why? Because with respect to E2 and E3, you normally give a 10,000 discount. So this bundle of goods, the 10,000 discount should be allocated first. The remaining 10,000 is to be allocated between E1 and E2 and E3 being treated as a single bundle. So E1 is what? 3,000 and E2 and E3 it was what? 7,000. Now kindly just see if you people get it, because if you get this thing, you will actually get the next table. If you get that previous workings, you will understand this table now. It's originally the first 10,000 discount which is being allocated here, and then additional 10,000 discount that is being allocated here. Okay, good enough. So we are done with this part one of this specific question. And the part one, A1 was what? That if we offer these products for 90,000 and when E2 and E3 are being sold for 70, so what is going to be the allocation? So we have done that. Okay, let's move a bit forward and discuss further. Okay, now see, let's move a bit forward. I'll show you the screen again. Okay, now let's move a bit forward and discuss further. Now, the next thing is it says SL offered to sell 1 unit of E1 and 2 units of E3 for 104,000. So, how exactly are we going to be accounting for it? Let's try to understand this. So see what happens is what is the standalone price? The standalone prices of these E1 is 30,000, E3 and E3, 50,000, 50,000. So the standalone prices of all of these is 130,000. What have we done? We have actually sold them for 104,000. I repeat, the standalone prices for all of them is 130,000. And what happens is that you've got 104,000, that is what it is sold at. So what happens, the price allocated is going to be E1 would be like this: 30,000 divided by 130,000 multiply by 104,000. So resultingly what happens is 30 upon 130 multiply by 104 gives you 24,000. And two E2s will be worth what? 100,000 divided by 130,000 multiply by 104,000 gives you 80,000. So hence resultingly the total allocation is going to be 104,000. Resultingly the total allocation is going to be 104,000. Do you see how we have allocated the transaction price on the basis of standalone prices? On the basis of standalone prices. Okay for all of you? Yes, what happens is that I did not do it in the way I did the previous question, because in the previous question there was a bundle of discount. Okay, there are two E2s, right? So that's why each one of the E2 was each one of the E2 was 50,000. So that's why two E2s is 100,000. Ademola, please just leave that part right now because we are already going very slow. Um, it was basically 7,000 multiplied by, it was actually computed like this. 7,000, I'm really sorry, but I need to do a lot of questions and it's just slowing me down. 43,750 divided by 70,000. That is what it is. Okay, now let's move a bit forward. So we have actually gone through this specific point that how this transaction price is going to be allocated in this case. Now let's move a bit forward and discuss further. This is part B of the question. And the part B of the question actually covers up the situation when the revenue is recognized over a period of time and the revenue is recognized at a point in time. Now try to understand this thing. It says on 1st October 2018, Kushan Construction Limited entered into a contract to construct a commercial building. Entered into a contract to construct commercial building. To construct a commercial building for a customer for 50 million and a bonus of rupees 10 million if the building is completed on or before 31st December 19. Till 30th June 2019, KCL expected that the building will be completed within time at a total cost of 40 million. However, due to bad weather, the time involved in regulatory approvals, the building was completed on 28th Feb 2020 at a total cost of 42 million, of which 26 million was incurred till 30th June 2019. The requirement is compute the profit to be recognized for the years ended 30th June 19 and 30th June 20 if the performance obligation under the contract is satisfied over time. If the performance obligation under the contract is satisfied over time. Number two, performance obligation under the contract is satisfied at a point in time. So this is something that you have to do. See, what happens is you are constructing a building. The work is started in 1st October 2018. And when the work is started in 1st October 2018, you were being given a timeline that if you complete the project by 31st December 2019, then what happens is you will get a fixed price of 50 million and you would get a bonus of 10 million. You would get a fixed price of 50 million and you will get a bonus of 50 million. Sorry, a bonus of 10 million. Now, try to understand something, which is basically that a very important point with respect to the revenue recognition. I repeat, a very important point with respect to revenue recognition is that you have to establish the transaction price. You have to establish the transaction price. So if I try to establish the transaction price at 30th June 2019, so this 50 million was something that was to be received, and this 10 million was highly probable. This 10 million was highly probable. So that means 60 million was the total revenue that was highly likely to be achieved. So what happens is at 30th June 2019, this is what the transaction price was. At 30th June 2019, this is what the transaction price was. Now what next is there? So I repeat, what happens is at 30th June 2019, you have to say that the transaction price is what? That the transaction price is 60 million. Now try to move a bit forward. What happens then is that this contract is being completed on what? The contract is being completed on 28th Feb 2020. Now, if the contract is being completed at 28th Feb 2020, so that means at 28th Feb 2020, we have already delayed the completion of the contract. So now the transaction price is going to be 50 million. We have already delayed the completion of the contract. So therefore the transaction price is going to be what? Only 50 million. Now, how exactly are we going to be recognizing the revenue? So I will explain to people that this is one of those scenarios where the revenue is recognized over a period of time. So when the revenue is recognized over a period of time, so you need to use either the output method or you need to use either the input method to ascertain the stage of completion. To ascertain the stage of completion. I repeat, the revenue is recognized over a period of time. So what do you need to do? You need to establish either the output method or the input method for establishing the stage of completion. Now, how exactly are you going to do it? Let's try to understand. So here, what could happen is, I repeat, here what could happen is, we do know we can use the input method. And what is that input method going to be? You can use the cost assessment. I repeat, what you could do is that you could use the cost. I repeat, what you could do is that you could actually use the cost. Now, so what we could do is that at 30th June 2019, we know that the percentage completion could be established like this. The cost incurred to date divided by the expected cost. So the cost incurred was what? 26 million at 30th June 2019. And the total estimated cost was 40 million. So if it was 26 divided by 40, So that means 65% is the stage of completion at 30th June 2019. And at 28th Feb 2020, the contract is 100% complete. So how do we recognize the revenue? So let's understand this thing. For the year till 30th June 2019, you would say the sales are going to be what? The expected transaction price is 60 million. The contract is 65% complete. That means 39 is going to be the sales. The costs are going to be what? 40 into 65%. The costs are going to be 26. Resultingly, what happens is, you will have a profit of 13. Resultingly, what is going to happen is you will have a profit of 13 that needs to be recognized. So up till the year ended 30th June 2019, this is how the transaction is going to be recognized. Let's move a bit forward. For the year ended 30th June 2020, the sales that need to be recognized now are of 50 million, but we have already recognized 30 million of the sale. So that means 11 million is the sale that needs to be recognized in the current year. Why? Because what happens is you have already recognized 39 million and it's a change in your estimate. The next thing is going to be with respect to the cost. So the total cost has been 42, of which 26 has been recognized in the previous period. So it's going to be 16 million, and hence a loss of 5 million is going to be recognized in the current year. So cumulatively, what you could do is that if you try to establish the cumulative sales of this, so in 2019, in 2020, and this is what total. So resultingly, what happens is the sales that have been recognized is 39, the sales that have been recognized 11, a total of 50. The cost of goods sold is what? 26. The cost of goods sold is 16, and resultingly the total is 42. So hence the total is going to be what? The total is going to be 8, 5, 30. This is how you're gonna be recognizing it. I repeat, this is how you're gonna be recognizing it. Is this okay now? This is how the revenue is recognized over a period of time. I repeat, this is how the revenue is recognized over a period of time. That in case if you have to recognize the revenue over a period of time, this is how you will do it. I repeat, this is how you will do it. Okay, are you done now? Okay, let me show you the stage of completion. You can see the stage of completion now also. Yeah, you can now see the stage of completion also. Okay, good enough. So what have we done? We have actually talked about the revenue recognition in a scenario when the revenue is recognized over a period of time. I repeat, when the revenue is recognized over a period of time. Now let's move a bit forward and discuss further. The next thing that we need to understand is that it says, let us know that how this revenue is going to be recognized if the performance obligation is satisfied at a point in time. Now, what does it say? It says, let us know how the performance obligation is going to be satisfied. If I mean, like how the revenue is going to be recognized, the performance obligation is satisfied at a point in time. So when the performance obligation is satisfied at a point in time, this would actually mean what? This would actually mean that you would be recognizing the revenue when the 100% of the contract is complete. And if the 100% of the contract is complete, so that means in 2019, the revenue recognition would be like this. Sales is going to be zero. The costs are going to be zero. The profit or loss are going to be zero again. And in 2020, what is going to happen is that you would recognize the entire sales, you would recognize the entire cost, and you would recognize the entire profit of this eight. This is how you are going to be recognizing it. I repeat, this is how you are going to be recognizing it. Yeah, do you people get it? I repeat, this is how you are going to be recognizing it. Okay, now, so we've gone through this part also, which was about the computation of the profit to be recognized for each of the year if the performance obligation under the contract is satisfied over time or if it is satisfied at a point in time. Now the requirement number C is that it says the nature, timing, and amount of consideration promised by a customer affect the estimate of the transaction price. It says define the term transaction price and list down the factors that may affect the determination of the transaction price. So I won't be discussing it much. It's something of a textbook item that is actually there. So you people can refer to the textbook to identify this. But what I could tell you people is that um, the transaction price could be affected because of the transaction price could be, I mean, like there are multiple factors, which is the time value of money that will have an impact on transaction price, the variable consideration that would have an impact, the non-cash consideration also needs to be considered. Also, the constraints on variable considerations. So all of these things need to be considered. The constraints on the variable consideration. So I repeat, all of these things need to be actually considered when you are going to be recognizing, this transaction price. So for you to be recognizing the transaction price, This is something that you would have to keep in mind. I repeat, for you to be recognizing the transaction price, this is something that you would have to keep in mind. Is that okay now? Okay, so we are done with one of the questions, and the name of this question was Stupa Limited. The name of this question is the financial statement of Trich Limited. The requirement under this question is prepare correcting entries for the year ended 31st December 19 in accordance with IFRS 15. The time right now is 11:38 p.m. I am giving you time till 11:45 p.m. to try this question. I'm giving you time till 11:45 p.m. to try this question. That is 7 minutes time. Let's try this question. It says on 1st October 2019, we are talking about the year ended 31st December 19. I repeat, we are talking about year ended 31st December 19. It says on 1st October 2019, TML sold machine C to Chen Limited for 25 million. As per the contract, the payment would be made after 2 years. As per the contract, the payment would be made after 2 years. The accountant recognized sales revenue of 25 million upon delivery on 1st October 19. Further, the commission paid to sales employees for winning the contract of 1.6 million was capitalized and is being amortized over 2-year periods. The applicable discount rate is 10% per annum. Now let's try to have an understanding that how exactly should we be recognizing it. See, what happens is if I talk about this TML Limited, if I talk about this TML, if I talk about this TML, what is actually going to happen is that you are making the sales on this 1st October 2019. This is the date of sale. I repeat, this is the date of sale. And what happens is the amount would be received in 2 years' time. The amount would be received in 2 years' time. And how much is going to be the amount that would be received? So the amount that is going to be received is going to be 25 million. I repeat, the amount that is going to be received will be 25 million.
The amount that is going to be received will be 25 million. The amount that will be received is going to be 25 million. Now, what actually happens is, if the amount that is going to be received of 25 million, so what you need to do is that you need to understand that there is the financing component that is involved. There's a financing component that is involved. So at time period this 1st October 2019, the revenue that should be recognized is going to be what? The revenue that should be recognized is going to be the present value of the 25 million which is receivable. The revenue that is going to be recognized will be present value of the 25 million receivable. How exactly are we going to be recognizing this revenue? So we are going to be recognizing this revenue like this. We are going to say 25 million into 1.1. The discount rate is 10%, right? Into 1.1 power minus 2. So resultingly what is going to happen is 25 million divided by 1.1 divided by 1.1 gives you 20.66. Gives you 20.66. So at 1st October 2019, what do you need to do? You need to recognize what? You should have recognized the sales of 20.66, whereas what you have done is you have recognized a sale of 25 million. So you're going to say that the revenue or the sales is going to be debited, and correspondingly the receivables is going to be credited. By how much amount? 25 minus 20.66. So hence resultingly what is going to be happening is 44.34, 4.34. This is the amount by which the sale needs to be reversed. This is the amount by which the sale needs to be reversed. I'm sorry, my microphone that was selected was a wrong microphone. That's why the voice wasn't very good in the initial period of the class. I just checked out that the microphone selected was the wrong one. That's why. So I just changed the microphone now. Now see, what happens is that the revenue needs to be reversed. The revenue needs to be reversed and the receivable also needs to be reversed. I repeat, the revenue and the receivable both needs to be reversed. Now, what next is there? So you've recognized this revenue and the receivable. The next thing that you need to do is that you need to recognize the adjustment. You need to recognize the adjustment for. You need to recognize the adjustment for the interest income. I repeat, what do you need to do? You need to recognize the adjustment for the interest income. So the revenue that, the amount of adjustment for the interest income up till 31st December 19 is going to be what? Up till 31st December 19, the adjustment is going to be like this. You would say the opening receivable is 20.66. The unwinding of discount at the rate of 10% for a period of 3 months is going to be what? It's going to be 20.66 multiplied by. It's going to be 20.66 multiplied by 10% multiplied by 3 divided by 12. Resultingly 0.5165. So hence what happens is, if it is going to be 0.5165, what are you going to do? You're going to say the receivable will be debited by 0.5165 and you would say the interest income is going to be credited by 0.5165. Now what next is there? With respect to the contract asset, so it should have been recognized as an expense at the time the sales was made. So what we should be doing is we should be saying that whatever the commission expense that was recognized as an asset, the commission expense is to be debited by 1.6 million. The contract asset is going to be credited by whatever amount that is actually recognized, and the amortized expense is going to be reversed also. So hence what happens is, if we try to look at this, it's actually going to be what, how much you would have recognized. You would have recognized this much, 1.6 multiplied by, divide by 2, multiply by 3 upon 12. So it's actually going to be 0.2. So this is going to be 1.4. So you see, at Emola, this is 0.5165. This is not 1.70.5165. It's 0.5165. Okay. It's not a contract asset. Amina Mohsen, I'm just de-recognizing it. They've recognized an asset. They've recognized an asset because they've capitalized it. When you capitalize something, that means you recognize it as an asset. So if they recognize an asset, so I am actually de-recognizing it.
No, it should not be capitalized. It should be immediately expensed out. It's not something that's going to give you benefit for the next 2 years. You have sold the goods, the amount is earned, the revenue is recognized, things are over. Do you people get it now? Yeah, do you people get it? Okay. Michelle, basically what happens is 1.6 million was the amount that was recognized as an asset because it was capitalized and it's being amortized over 2 years. So what did I establish? I established that how much amount would have they amortized, because you see what happens is amortization means they would have been transferring the asset to the P&L. So 1.6 million divided by 2 multiplied by 3 divided by 12. This is what the amortization is going to be. I paid 1.6 divided by 2 multiplied by 3 divided by 12. This is what the amortization is going to be. Yeah, is that okay now? Yeah, is that okay now? Okay, now let's move on to the second part of this question. Let's move on to the second part of this specific question. The second part of the question is actually like this. Yes, Imran Makbul, that's how it is. The second part of the question is, it says TML entered into a contract to manufacture a specialized machine for Dhan Limited at a price of 30 million. The contract meets the criteria for recognition of revenue over time. At year end, the machine was 60% complete and it was estimated that a further cost of 10 million would be incurred. Cost of 15 million incurred till year end has been included in closing inventory and receipt of 11 million have been credited to revenue. So what have they done right now with respect to part B of this question? With respect to part B of this question, they have actually recognized 15 million incurred till year end has been recognized in closing inventory. They have recognized the inventory debited by 15 million and they have recognized cash credit by 15 million. That's one treatment that they have done. The second thing that they have done is they have recognized a receipt of 11 million and they have said that the sales is going to be credited by 11 million. So this is what they have actually done. I repeat, this is what they have actually done. Now, when you recognize the revenue over a period of time, how do you actually recognize the revenue? Try to understand this thing. One thing is, with respect to the sales, the amount of sales that must have been recognized is from the 30 million, you should have recognized 60%, that is 18 million must have been recognized. So what do you need to do? You need to say that we have received 11 million and we have recognized 11 million as a sale. So the difference between this 18 million and 11 million is 7 million. The difference between this 18 million and 11 million is 7 million. So what do you need to do? You should recognize a receivable of 7 million and you should recognize more sales of 7 million. Why? Because you have not recognized 18 million as a sale. So you should be doing it. I repeat, what you should be doing is you should be doing it this way. So one of the correcting entries is going to be this. The second correcting entry is going to be, you would say the cost of goods sold would be debited by 15 million. And correspondingly, the inventory is going to be credited by 15 million. Now, a lot of you would be asking that, how did you get it? Let me tell you. The cost to date is 15. The further cost estimated is 10. So resultingly it's 25. When you say 25 multiplied by 60%, you end up getting 15. Is that how it is? Is that how it is? 25 into 60%, 15. Yes. So you must be recognizing 15 million as an expense in the P&L because 60% of the contract has been completed. I repeat, because 60% of the contract has been completed. No, we don't do it this way. We establish the total estimated cost. So 15 million has already been incurred. You are expected to incur further 10 million. Resultingly, 25 million is going to be the total cost. So of the 25 million, 60% has to be recognized in the P&L. So that means 60% of this 25 million is going to be what? Is going to be 15 million. That has to be recognized in the P&L. Okay. Now you see, if you are going to be recognizing Amina Mohsen, if you are going to be recognizing revenue over a period of time, so that means the cost of goods sold is also going to be recognized over a period of time. You cannot recognize inventory. You have recognized inventory here. So you have done it wrong. You have done it wrong
The inventory debited, the cash credited. It's a wrong entry. If you have to recognize the revenue over a period of time, so the COGS also needs to be recognized. No, we should not recognize inventory. No, 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 no. If I was supposed to recognize inventory, I would have not recognized this entry as the correcting entry. I have just expensed out the inventory. I have said that inventory credit, COGS debit. Why would you book an inventory? You are recognizing revenue. That means you are transferring the goods. If you are transferring the goods, they should be recognized in the buyer's books, not in your books. It's not your inventory anymore. You have expensed it out. You have recognized revenue. That means you have transferred the risk and rewards to them. This is not something that I have done. This is the examiner's entry. I've just mentioned to people, this is the examiner's entry. This is the examiner's entry. I've just passed some of the correcting entries. I mean, these correcting entries are the ones passed by myself. Okay, let's move a bit forward. Now see, so we have gone through this specific question also. Now the third part is, it says TML entered into a contract to sell 1 unit of machine A and machine B for a total price of 16 million. Machine A was delivered in December 19 to the customer, while machine B was delivered in January 20. So machine A was delivered in December 19. Machine B was delivered in January 20. The consideration of 16 million is due only after TML transfers both the machines. So try to understand this. What is the examiner saying? The consideration becomes due only after TML transfers both the machines. TML sells machine A and machine B at a standalone price of 12 and 8. Accountant recognized receivable and revenue of 12 million upon delivery of machine A. Now there is something that you need to understand with respect to this third part. What is that? The revenue is to be recognized when the performance obligation is satisfied. Under the current contract, the performance obligation required entity to deliver machine A and B. The consideration becomes receivable when both the machines have been delivered. This indicates that till the time both machines are delivered, revenue cannot be recognized. Hence, the revenue recognized on delivery of one machine is to be reversed, and a contract asset is to be recognized to the extent of the amount that that has not become, will become receivable once the other machine will be delivered. So how exactly are you going to do it? You're going to do it like this. You would say that we've got machine A, which is normally worth 12. We've got machine B, which is worth 8. So resultingly, the total price of these two machines is 20. The contract is of 16 million. So that means the price allocated to A would be 16 divided by 12 into 20. To B is going to be 16 into 8 upon 20. Hence, what happens is the price is going to be what? 9.6 here. And it's going to be 6.4 here. So this is how the total price of 16 is going to be made up. So if we have to allocate the transaction price, this is how we are going to be allocating the transaction price. So now what have they done as an entity? They've actually recognized. I repeat, what have they done as an entity? So let's try to understand this. Basically what happens is you have not delivered both the machines. That means you cannot recognize the revenue. That means you cannot recognize the revenue. So what happens is, what have you done right now? The TML, the accountant recognized receivable and revenue of 12 million upon this delivery of the machine A. So what happens is, see, the revenue can be recognized for this machine A, but you cannot book the receivable. See, what are you going to do? Let me just update if I have written something wrong. Revenue is to be recognized, performance obligation under current contract, performance obligation. The consideration becomes receivable when both the machines have been delivered. However, a contract asset and revenue for the machine delivered can be recognized. There is a bit of the error that I made in writing down. I've just updated the answer. So now see, what is actually going to happen is that, let me help you people understand. What you are going to do is that your accountant, what he has done is he has recognized the receivable debited by 12 and he has recognized the sales credit by 12. Now what we are going to do is that we are going to tell him that, look, if you had to recognize, what you should have done is, you should have done the things like this. You should have done the things like this. You should have only recognized a contract asset debit by 9.6 and revenue credit by 9.6. This is the only thing that you should have recognized. I repeat, this is the only thing that you should have recognized. Why? Because you are allowed to recognize this revenue of 9.6. The reason being the goods have been delivered, but your receivable cannot be booked. All that you have to do is that you have to book a contract asset. What is this contract asset? This is a right of the right of collecting the consideration in the future. But the receivable is not established right now. I repeat, the receivable is not established right now. You can only recognize contract asset that you have actually transferred your inventory to this specific company. So what are you going to do? You're going to say, I repeat, what are you gonna do? You're gonna say that this is the entry recorded. This is what should have been recorded. One of the entry is being recorded. The other one of them is the entry that should have been recorded. Now see, what happens next is that we are now going to recognize a correcting entry. What is this correcting entry going to be? The correcting entry is going to be like this. The receivable is going to be credited by 12 million. We can recognize proportionate revenue. The receivable is going to be credited by 12 million. Our contract asset is going to be recognized by 9.6 million. I repeat, a contract asset is going to be recognized by 9.6 million. And you would say that the sales are going to be reversed by the balancing figure, which is 2.4 million. So this is what the correcting entry is going to be. Now, don't get confused. I'm telling you, this is what he has recorded. This is what should have been recorded. And this is how you will correct the things. Is this okay now? Okay, the receivable cannot be recognized because you don't have a right to receive cash right now. A contract asset would be recognized because we have transferred them the asset. The receivable is going to be credited by 12 million. The sales are going to be debited by 2.4 million because only 9.4 million sales could be recognized. Contract asset is debited by 9.6. Yes. So this is how you're going to be recognizing this specific scenario.
Let's try to attempt this part 2 of this Tang company. Let's try to attempt part 2 of the Tang company. You can take 5 minutes and then I'm going to start off. It says Tang enters into a contract on 1st December 2004 to construct a printing machine on a customer's premises for a promised consideration of 1.5 million with a bonus of 100,000 if the machine is completed within 24 months. So what's actually happening is at 1st December 2004. At 1st December 2004, there is a contract under which a fixed price contract of 1.5 million, and there's going to be 100,000, which is going to be the variable consideration that's involved. And that means this is 1.6 million, and this 1 million is only if the contract is going to be completed within 24 months. It says at the inception of the contract, Tang correctly accounts for the promised bundle of goods and services as a single performance obligation. What happens is, at the inception of the contract, Tang correctly accounts for the bundle of goods and services as a single performance obligation in accordance with IFRS 15. At the inception of the contract, Tang expects the cost to be 100,000. So what is actually expected is the expected costs are going to be 800,000, and concludes it is highly probable that a significant reversal in the amount of cumulative revenue recognized will occur. Now, when you are expected to have a significant reversal in the amount of cumulative revenue, that means that it is highly unlikely that this 100,000 would be earned. That means only 1.5 million, the fixed price out of this contract, is going to be earned. It's a question mark with respect to the variable. It's a question mark with respect to the variable consideration, whether that would be earned or not. Now, it says completion of printing machine is highly susceptible to factors outside Tang's influence, mainly issues with supply of components. So they are dependent upon the external third party supplier. That if the third party is going to supply the components to them, then they would be able to supply those goods on time. Now, it says that 30th November 2005, Tang has satisfied 65% of obligation on the basis of cost incurred to date, and concludes that variable consideration is still constrained. Now, if the variable consideration is still constrained, that means the variable consideration cannot be recognized. However, on 4th December 2005, the 4th December 2005 is after year end. So it's after year end. The contract is modified with the result that fixed consideration and expected cost increased by 110,000 and this respectively. So there is actually a contract modification that's happening over here. The time allowable for achieving the bonus is extended by 6 months, with the result that Tang concludes it's highly probable that the bonus will be achieved and that the contract will remain a single performance obligation. Tang has an accounting year end of 30th November. Now, what do we need to do with respect to this Tang company? Try to understand. First of all, what you would do is that you would say that at 30th November 2000x5, what happens is, how much is the total revenue that is expected? 1.5 million. Why? Because we don't expect that we will be able to earn the bonus. The costs are expected to be 800,000. So this is what is expected, that you would have a profit of 700,000. What is expected is you would have a profit of 700,000. Now, if you are expected to have a profit of 700,000, then what happens next? What happens next is that 65% of the contract has been completed till date. 65% of the contract has been completed till date. So that means what happens is 1.5 million into 65% is the amount of revenue that could be recognized. 1.5 million into 65% is the amount of revenue that has to be recognized. So it has to be 1.5 million into 65% gives you 9,75,000 is the amount of the revenue that needs to be recognized. The cost of goods sold that you need to recognize is basically 800,000 is going to be 800,000 multiplied by 800,000 multiplied by 65% gives you 5,20,000. So resultingly what happens is, when we talk about it, what happens is you've got 975 less 520. So you've got approximately 455,000 of the profit that's going to be recognized with respect to this specific contract. Now this is the accounting up till 30th November 2000x5. What has happened is on 4th December 2000x5, there is a modification into the contract. What you need to understand is this is actually an event after reporting period. This is an event after reporting period. What you need to understand is This is an event after reporting period. Now, if it's an event after reporting period, what exactly is it going to be? Try to understand this. Basically, if it's an event after reporting period, that means you don't have to account for it in 2000x5, but it is rather going to be accounted for in 2000x6. But what is actually going to happen is on 4th December 2000x5, the date of the modification, there's going to be an adjustment to the revenue and the COGS that has been recognized to date. I'm repeating, it's an event after reporting period and a non-adjusting event after reporting period. But at 4th December 2000x5, you need to have an adjustment to the revenue and the COGS, and that too, that adjustment is going to be what? That adjustment is going to be considered to be, there is going to be a one-time adjustment to the revenue and the cost of goods sold. And when there is going to be this one-time adjustment to the revenue and the cost of goods sold, this specific adjustment is actually named, the adjustment is named cumulative catch-up. This adjustment is named as cumulative catch-up in accordance with IFRS 15. What's actually happening is once you have a contract modification, then what happens is at the date of modification, you need to bring about a adjustment, which is a cumulative adjustment of the revenue and the cost of goods sold that has been recognized till date. And this is actually going to be termed as cumulative catch-up. Is going to be termed as cumulative catch-up. Is this okay to everyone? Yeah, is that okay? Now, what is 520? 520 is the cost of goods sold. 520,000 is the cost of goods sold that you need to recognize. So what actually happens is there is actually going to be an adjustment called the cumulative catch-up adjustment. Okay. So because of their modification, what you need to do is that you need to perform a cumulative catch-up adjustment. Now, what is going to be the cumulative catch-up adjustment? You would say the revenue is now going to be 1.5 million plus 100,000 because it's highly likely that the variable consideration is going to be earned plus 110,000, which is actually going to be because we are being told that 110,000 is now going to be the additional revenue that would be earned. The contract is supposed to be completed 65%. The contract is supposed to be completed 65%. So if the contract is supposed to be completed 65%, that means what is the amount of revenue? What is the amount of revenue that has to be recognized? Let's try to understand this. The amount of revenue that has to be recognized is 1.5 million plus 1 million plus 110 multiplied by 65%. This is 111,500. The cost of goods sold is going to be what? The cost of goods sold is going to be the 60,000. How much is it going to be? It's actually going to be the original estimate, which was 800,000 plus 60,000 multiplied by 65%. So can you just please establish that how much is it going to be? So it makes it 5,59,000. Hence what happens is there's going to be a profit of 552,500 that needs to be recognized up till now. So what you need to do is that you need to adjust. What is that adjustment? The new revenue and the old revenue. So this is the adjustment figure. The new revenue that you have got is 111,1500. The old revenue that we had recognized was 9,75,000. So what happens is you've got 136,500, and for the cost of goods sold, what you're gonna do is that you're gonna say the previous recognition was 520,000, and it is now 559,000. So this is actually going to be 39,000. So this is the cumulative adjustment that you need to do with respect to, I'm repeating that this is the cumulative adjustment that you need to do with respect to the revenue recognition. So is everyone okay with this? Okay, okay. Thank you. Thank you. Kindly review this, kindly just look at it if you are able to understand this. This adjustment is a one-time adjustment that's going to be recognized at 4th December 2005. 60,000 is the additional cost that's going to be incurred in order to complete the contract. This entry will be passed in the next year. Yes, Ayla Bhatkal, this will be passed in the next year. Okay, now there is something that I would want you people to understand, which is basically, if you all are okay, then I need to tell you something more. Are you all okay with this? Okay, now what I need to tell you is that there is an error in this calculation. There is an error in this calculation, and I have actually made an intentional error. There's an error in this calculation which I have made an intentional error just to help you people understand that how the cumulative catch-up adjustment is made. You see, we were being told in the question that it's 65% completed. So technically what would happen is, if I tell you to adjust, you all would do 65% into this. But the problem over here is, read these lines. It says Tang has satisfied 65% of its obligation on the basis of cost incurred to date, and concludes variable consideration is still constrained. So that means the stage of completion of the contract is not on the basis of revenue. It's on the basis of cost incurred to date. So basically what you need to do is that you need to actually be calculating the revised stage of completion. How would you do it? Try to understand. If you are expecting the original cost to be 800,000, and if the contract is 65% completed, so that means what happens is you have actually completed, you have actually incurred 520,000 as the cost incurred on this date. Now try to understand. Now the revised stage of completion. Revised stage of completion is going to be what? The revised stage of completion is going to be, the revised stage of completion is going to be 5,20,000, which is the cost incurred to date, divided by 800,000, which was the original estimate of total cost, plus 60,000. So this makes it what? This makes it 60.46% stage completion. So rather than using this 65% here, you should be using 60.46. I have intentionally made this error just to help you people understand, because once you make an error, you get a better understanding. Once you make an error, you get a better understanding. Now, if somebody is going to ask me a question, why not 65%? Why 60.46%? That is because the stage of completion is established on the basis of cost incurred as compared to the total estimated cost. So these values are going to change. The approach would remain the same. It's just that the stage of completion is going to change. The entire approach would remain the same. It's just that the stage of completion would change. There is an intentional mistake that I made while doing this question, just to help you people understand. Now kindly go through it and confirm to me if you are able to understand. Okay, there is a question. In that case, we only have to revise the revenue to date. Yes, revenue plus cost, both. Because you see, the percentage of cost also needs to be changed. In fact, yes, the cost would remain the same, 520,000. There's going to be no adjustment to the cost. There's going to be no adjustment to the cost. It would remain 520,000. There's only going to be the change to the revenue. Yes, we need to take 60.46, not 65. This 60.46 is going to be applied to both revenue and cost. But if you apply it to the cost, you will end up getting 520,000. But for the revenue, it is going to change. Can somebody please let me know how much is going to be the change revenue? Okay, the changed revenue is going to be 973,488. It's going to be 973,488. There's going to be 5,20,000. So hence what happens is there's going to be 453,488. This specific sales would now become 973,488. So there is actually going to be a revision of the revenue. Which means 1512 is going to be a reduction in the revenue that you need to recognize. Is this okay to everyone? Well, Edna Fadero, you have made a rounding off issue with the problem is that this is not exact 60.46%. This is 60.4599778, etc. That's why there is a nominal difference that is arising. There is a nominal difference that is arising. Are you okay with this now? Okay, so we are done with this question, the name of which was Tang Company. What was the name? Okay, how did I get 973,000? Ahmed, I just explained to you. It was 1.5 million, the fixed price contract, plus 100,000, which is the variable consideration, plus 110,000 more, which is the additional consideration that has been agreed. This all needs to be multiplied with 65%, oh sorry, 60.46. Okay, are you getting 60.46% by this? Okay, if I have made a mistake, I'm getting 973,406. I'm getting 973,406. Okay, just wait. Let me go through the answer again. It says, that you were supposed to have, see, it was a fixed price contract with we getting 1.5 million and the cost estimated was 800,000. Since this contract was 65% completed, then 1.5 into 65% is the revenue that needs to be recognized and this cost needs to be recognized. There is a modification on the 4th of December. The modification leads to a situation where we get an additional 100,000 in the revenue, 110,000 in the revenue, and we are highly likely to earn a bonus of 100,000. Okay. So what happens because of this is that, um, our accumulative adjustment needs to be made. Now, cumulative adjustment needs to be made of what? The cumulative adjustment needs to be made of the modification. Now, how much is the amount of the modification that needs to be made? So I told you that you need to calculate the stage of completion. How would you do it? You would do it this way. You would say the present cost incurred was 520 on the basis of 800. But now the total expected cost is 60,000. On this basis, we have got 60.46 as a stage of completion. On the basis of this stage of completion, this revenue, which is basically 1500, 1600, 1710. Out of this, we have got this 1710,000 into 60.46%. Okay, you are right. It's going to become 1033,866. This is going to remain 5,20,000. Hence, what is going to happen is, your profit is now going to be 5,13,866. So what is actually going to happen is you'd incorporate the adjustments like this. You'd say the new cost is also going to be 520,000. The old cost is also going to be this. There's going to be 1033,866 as an adjustment in it. It's going to be 58,866. Hence, what needs to be done is there has to be an adjustment of 58,866 to the revenue. Are we all okay now? Yeah, are we all okay now? Yeah, is that okay? Okay, good enough. Now, this is a question named Tang. What you could do is that you can take 5 minutes. You can attempt part one of this question. Then we'll discuss part two also. But it says discuss how the above two contracts should be accounted for under IFRS 15. In the case of B1, discussion should include accounting treatment up to 30th November 6. And the case of B2, accounting treatment up to 4th December 2005. So let's try to let's try to figure out this one first. Then we'll move on to the second one. Quickly, let's try to do this, please. I'm a bit confused with distinct product or services. What if the products or services promised to provide are not distinct? How are they going to be treated? Okay, if the products and services are not distinct, they'll be treated as a single performance obligation. They'll be treated as a single performance obligation. They'll not be treated as multiple performance obligation. They'll be treated as single performance obligation. Now, let's move a bit forward on this. It says Tang enters into a contract with a customer to sell an existing printing machine such that control of the printing machine vests with customer in 2 years' time. So what he has done is he has decided to sell a printing machine to the customer such that the control of the printing machine vests with the customer in 2 years' time. So the control is going to be transferred in 2 years' time. It says the contract has two payment options. The customer can pay 240,000 when contract is signed, either at year 0, 240,000, or 300,000 in 2 years' time. In 300,000 you could pay 300,000 you could pay in 2 years' time. Now what next is there? Let's try to understand this. So we are being told that at time period 0, the value is going to be 240,000. At time period 2, it will be 300,000. It says when the customer gains control of printing machine, the interest rate implicit is 11.8% in order to adjust for the risk involved in the delay in payment. However, Tang's incremental borrowing rate is 5%. The customer paid this much on this date when the contract was signed. We are required to account for this contract up till 30th November 2006. So let's try to have a discussion. Let's try to have an understanding. When we talk about the concept of this Tang company, let me talk about it. If we talk about this Tang company, so with respect to this Tang company, what do we have? We have got this Tang company. It says that there is a significant financing component involved. What is involved? There is a significant financing component involved. Now, what exactly do you mean by this significant financing component being involved? So let's try to understand this. Basically, we've got the money at year 0, which is 240,000. The normal circumstances is we would have got the money at year 2, which would have been 300,000. So the effective interest rate is 11.8%. Now, what we usually do is that we don't consider 11.8% the effective rate. We rather identify, you would identify this Tang company's incremental borrowing rate. You would identify this Tang company's incremental borrowing rate in this scenario. Why? Because it's actually the Tang company which has got a loan in this specific scenario. So how exactly are we going to be recognizing this whole transaction? We would say at time period 0, which is the 1st December 2000 x4. We're going to say that cash is going to be debited by 2,40,000, and there is going to be the contract liability which is going to be credited by 2,40,000. So you've got cash which is debited by 2,40,000. You've got a contract liability which is going to be credited by 2,40,000. Now, what happens here is you've got a liability which is 2,40,000, and there's going to be the unwinding at the rate of, there's going to be an unwinding at the rate of 5%. So if there is going to be unwinding at the rate of 5%, how much is it going to be? You will have 2,40,000 multiplied by 5% gives you 12,000. So hence resultingly this becomes 2,52,000. And then at time period 2, you would have another interest at the rate of 5% on it. So which is actually going to be 12,600. Resultingly what happens is you'll have 2,64,600. Now, so basically the accounting treatment, the way it's going to be treated, 30th November 2000x5, we are going to say we're going to say that interest cost debited by 12,000, and we are going to say the contract liability credited by 12,000. Then at 30th November 2000x6, you would say interest cost debited by 12,600, and there's going to be a contract liability credited by 12,600. And then what is actually going to happen is you would say that at this date, since there is now no liability, so the contract liability is going to be debited by 2,64,600, and we shall be recognizing the sales at 2,64,600. This is a similar type of question, a similar type of example that I told you people also when I was explaining you people the concept of the significant financing component involved with respect to the transaction price. So I told you people that this is how it all goes about. Yeah, is that okay to everyone? Yeah, I've zoomed out just because so that you people could see. Is it okay to everyone? Okay, this is good now. So we have actually been able to do this specific part of the question, Tang.